Singapore's biggest developer, CapitaLand, is splitting up its real estate development business and its fund management units. It's a strategy aimed at pursuing growth as an asset-light firm. It will combine its real estate investment management platform and lodging business into a separate listed entity. Its property development business will be privatised under a Temasek unit. Brendan Tanoto with more.
The new entity, called CapitaLand Investment Management, or CLIM, will be listed on the Singapore Exchange. It's set to become Asia's largest real estate investment manager, with assets under management of about $115 billion. CapitaLand Group CEO will take the helm of CLIM as Group CEO. He says the restructuring will pivot the firm from a development-focused business to one that's more asset-light and fee income-driven. He also addressed the timing of the move amid the ongoing COVID-19 pandemic.
With the vaccination rollout, my own sense is that the worst of COVID-19 is behind us, and we should be in a phase of recovery. So that's my own personal view at this point in time, and that's why we also think that it is right to accelerate our transformation and time to propose this restructuring exercise.
CapitaLand says it can also better write property development cycles to optimize returns by privatizing its real estate development business. Analysts say the restructuring bodes well for the firm.
This would mean that they would be able to conserve capital and use their capital much more efficiently. It would be beneficial to the shareholders potentially. It would generate better value, and it would be a more efficient manner of managing the balance sheet. The key questions are, how quickly will the real estate market recover to the pre-pandemic situation?
The restructuring is subject to regulatory conditions and the High Court's approval. CapitaLand's independent shareholders must also give the green light. The firm expects to complete the proposed restructuring in the fourth quarter of this year.
Well, for more, we're joined by David Kuo. He's a co-founder of The Smart Investor. David, well, what is the significance of CapitaLand's restructuring?
Well, essentially what it means, Elizabeth, is that as far as CapitaLand is concerned, the conglomerate has actually become too unwieldy. And so there is a property development side and also a landlord side. And the two don't really actually gel very well together. A developer sees tenants as being a lump of lead. A landlord, on the other hand, sees tenants as being a bar of gold. And what the landlord wants to do is to keep the tenant for as long as possible. The developer wants to get rid of the tenant as quickly as possible so they can move on to the next project. So I think what is happening here is that CapitaLand is accepting the fact that it's got to a certain size and it's now ready to split off the development side and the asset management side or the landlord side.
Yeah, and on this note, how is this going to change the landscape of property stocks on the SGX?
Well, eventually CapitaLand will be delisted. It will become private, but then we'll get another side. We'll get the CapitaLand Investment Management side, CLIM, being a part of the SGX. So we're losing one property company and gaining another one. So in that sense, probably not an awful lot. But what it does mean, though, is that CLIM, or CapitaLand Investment Management, is going to be more attractive to, I should think, Singapore investors who particularly like the idea of regular income rather than a developer such as CapitaLand. I mean, one of the problems with CapitaLand is that you get people like me sort of saying, hey, your return on equity is so low. When are you going to do something about it? Now they're going to take the fun out of that. And what we're going to be getting instead is CLIM, which will just churn out income for investors.
Well, as shareholders, they're going to be receiving about $4.10 in cash and stock. Do you think this is an attractive offer?
Oh, for sure, Elizabeth. I mean, at the moment, CapitaLand is, just before trading was suspended, was about $3.30, $3.31. So this represents a 25% premium on the closing price prior to the suspension of the shares. So I think a lot of people will be very delighted tomorrow. And what it also means is that when it does reach about $4.10, it means that its price to book will be 1. Currently, the price to book is about 0.75. So it means an immediate profit for any shareholders. Sadly, I don't own shares in CapitaLand, but what it means tomorrow is that the shares will pop and a lot of people will be popping their champagnes at the same time.
Well, before we go, David, this is also the third restructuring by a Temasek-related company to go asset light. Why are more of them doing so?
Well, because asset light is the current buzzword as far as management is concerned. You only have to have a look at, say, a ride-hailing company compared to a taxi company. A taxi company owns all the cars, whereas a ride-hailing company doesn't own any of the assets at all. So asset light is actually very good for shareholders because it means that you can move things from on the balance sheet from the asset side to the income side. And it really means you get a more efficient operation, just as one of your previous commentators, Nagunan, was saying, is actually good for shareholders.
All right, thanks so much. David Kuo, he's a co-founder of The Smart Investor.